Have you ever had that moment where you look at your savings account and feel proud? You skipped unnecessary purchases. You said no to impulse buying. Month after month, you watched your balance grow. $100 here, $200 there eventually. You reach a number that feels impressive. 5,000, 10,000, maybe even more. One day, curiosity gets the better of you. You check how much interest your bank actually paid you. And suddenly, your excitement disappears after an entire year. Your money barely moved. Meanwhile, everywhere you look, people keep talking about investing stocks, index funds compound, growth, financial freedom. And one question quietly starts echoing in your mind. Wait, have I been playing the game wrong this whole time? Here's the truth. Saving money is one of the smartest financial habits you can build. But saving alone almost never creates wealth. The real challenge isn't learning how to save, it's learning when and how to let your money start working for you. Today, we're going to walk through the exact psychological and practical path that transforms a saver into an investor without gambling your future or taking reckless risks, because the biggest financial mistake isn't spending everything, it's letting fear keep your money standing still. Imagine two friends, both are disciplined, both save exactly $10,000. The first friend leaves that money in a savings account earning around 1% per year. The second invests the same amount into a simple, diversified index fund that historically averages around 10% annually over long periods. After 1 year, the difference doesn't look life-changing. One has about $10,100. The other has roughly $11,000. Not exactly shocking. Most people stop thinking right there. But wealth isn't built in 1 year. It's built in 20, 30, 40. That's where the invisible force called compounding quietly changes everything. After 20 years, the saver ends up with around $12,000. The investor has roughly $67,000. Same starting point, completely different destination. And here's what's fascinating. The biggest wealth gap usually isn't between people who spend and people who save. It's between people who save and people who eventually invest. So why don't more people make that transition? The answer isn't math, it's psychology. Your brain loves certainty. A savings account feels safe because the number almost never goes down. You can open your banking app every morning and see exactly what you expect. That predictability feels comforting. Investing is different. Some days you're up, some days you're down. Sometimes the market drops 5% before lunch. Nothing actually changed about the businesses you own, but emotionally, it feels like something terrible just happened. Your brain confuses temporary uncertainty with permanent danger. And that's why millions of people never give investing a chance, not because they don't understand money, but because they misunderstand risk. Here's something most people never realize. Keeping all of your money in cash isn't risk-free. Inflation quietly reduces your purchasing power. Every single year, your bank balance may look the same, but what it can actually buy slowly shrinks. Sometimes doing nothing is the biggest risk of all. Now, before you think I'm telling you to invest every dollar you own, absolutely not. That would be a mistake. The smartest transition happens gradually. Step 1 is surprisingly boring. Build a real emergency fund. Before investing a single dollar, save enough cash to cover 3 to 6 months of living expenses. Why? Because emergencies don't schedule appointments. Cars break down, jobs disappear, medical bills show up without warning. If your investments become your emergency fund, you'll eventually be forced to sell at exactly the wrong time. An emergency fund doesn't just protect your lifestyle, it protects your future investments from your present problems. Now comes the mindset shift that changes everything. Stop thinking of your money as one giant pile. Instead, imagine 2 completely different buckets. The first bucket is called safety money. Its job is simple: protect you. It stays in cash. It gives you peace of mind. The second bucket is growth money. Its job is completely different. It exists to grow over years and decades. This bucket is allowed to fluctuate. It's supposed to. Once your brain separates these 2 buckets, something incredible happens. You stop expecting investments to behave like savings, and suddenly, market swings don't feel nearly as terrifying. Now comes the step that scares beginners the most. Actually, starting, here's the secret. You don't need thousands of dollars. You don't need to wait until you're rich. Many investment platforms let you begin with $50 or $100 at first. The amount barely matters. A habit does, because successful investing isn't built on giant decisions. It's built on hundreds of tiny, boring ones repeated over and over again. Every month, every paycheck, every year. Consistency beats intensity. Then comes another trap once people finally decide to invest. Many think they need to become financial geniuses. Overnight, they start researching complicated strategies, day trading options, hot stock tips, crypto speculation. They mistake complexity for intelligence. But history tells a different story. Some of the world's most successful investors recommend something incredibly simple: low-cost index funds. Instead of betting on one company, you own hundreds, maybe even thousands. You're not trying to predict tomorrow's winner, you're betting on long-term human progress itself. It's simple, diversified, and surprisingly powerful. Even legendary investor Warren Buffett has repeatedly suggested that most people are better off owning broad, low-cost index funds than trying to outsmart the market. Now, here's the part that almost sounds unbelievable. Let's say you invest just $300 every month. Nothing extraordinary, no lottery winnings, no six-figure salary, just consistency. If your investments average around 8% annually after 25 years, you'd have roughly $285,000. Here's the crazy part: you only invested about $90,000 yourself. Nearly $200,000 came from growth, not from working harder, not from earning another degree, not from finding the perfect stock, simply from giving time something to work with. Time is the one investment advantage that money can't buy. Later, every year you delay compounding loses another year to do its job. But let's address the question everyone eventually asks: what if I start investing and the market crashes? It probably will at some point. Every major market in history has experienced crashes. Some were scary, some lasted longer than expected. But here's what experienced investors understand: a market crash isn't the end of investing, it's part of investing. Imagine your favorite store suddenly puts everything on sale. Most people get excited, yet when stocks go on sale, people panic. The product is the same, only the price changed. Long-term investors often keep buying during downturns because every dollar purchases more shares. And when markets eventually recover, those cheaper purchases often become the most valuable ones. That's why investing isn't really a test of intelligence. It's a test of emotional discipline. The people who build wealth aren't necessarily the smartest. They're the ones who stay calm while everyone else reacts emotionally. So let's bring everything together. First, build an emergency fund that protects your life. Second, separate your money into safety and growth. Third, start investing small, even if it feels insignificant. Fourth, keep it simple with diversified long-term investments like index funds. And finally, give compounding something it desperately needs: time. Because here's the truth: most people discover far too late. Saving gives you security, investing gives you possibility. You need both. One protects today's version of you, the other quietly builds tomorrow's years. From now, you'll probably forget the exact amount of your first investment. You'll forget what the market did next Tuesday. You'll forget the headlines that once seemed terrifying. But you'll never regret giving your money the chance to grow while you were busy living your life. Because the most expensive financial decision isn't making the wrong investment, it's waiting so long. That time can no longer work in your favor. Your future wealth won't be determined by the day you started saving. It will be remembered by the day you finally decided your money should start working as hard as you do.